Welcome, everyone. I am so thrilled to be your guide through this explainer today because we are tackling Chapter 5. Now, Chapter 5 is literally the bedrock of your business planning taxation syllabus. Everything else you're going to learn, from the tricky international aspects to complex corporate gains, it all builds directly on the principles we're going to establish right here, right now. Let me be very clear right from the start. Mastering these mechanics, step by step, is the ultimate key to passing the BPT exam. So grab your notebooks, get comfortable, and let's dive into this. Here's a quick look at our syllabus for today's session. We're going to cover the core CGT framework, step-by-step CGT computations, shares and spousal transfers, special scenarios and losses, and we'll wrap up with winning BPT exam strategies. Pace yourselves because we're going to start with the basic frameworks and smoothly transition all the way up to those advanced edge cases. All right, let's get right into it with Section 1, the core CGT framework, focusing on the three essential elements. So, capital gains tax, or CGT, is actually only triggered by the simultaneous presence of three very specific elements. Without all three of these present at the same time, no CGT can arise, period. Element number 1 is a chargeable person. Usually, this means an individual who is resident in the UK at the time of disposal, though keep in mind there are some exceptions for non-residents holding UK property. And please note deliberately here, companies do not pay CGT, they pay corporation tax on their chargeable gains, so don't mix those up. Element 2 is a chargeable disposal. Think sales, gifts, or even a part disposal. And finally, element 3 is a chargeable asset. Now, the default rule here is that absolutely all assets are caught unless they are specifically exempt. This is exactly why you need to memorize the exempt list. We're talking about private motor cars, wasting chattels with a life of 50 years or less, UK government gilts, qualifying corporate bonds, and ICA investments. Now let's talk about the market value rule, because you really must understand that a chargeable disposal doesn't always require a commercial sale. If you just give an asset away to a family member, guess what? That is still a disposal. To prevent families from simply transferring wealth around at zero cost to avoid paying tax, the law steps in. It deems the proceeds to be the open market value, the OMV, at the date of the gift. The actual cash changing hands, even if it's zero, is completely irrelevant. Moving right along to Section 2, step-by-step CGT computations. Listen, this is the mechanical engine of the whole chapter. Sticking to this exact sequence is absolutely mandatory for the exam. Please do not improvise here. I highly recommend writing these 6 steps down. Step 1, always start with your proceeds, or the open market value if it's a gift. Step 2, deduct your base cost. That's going to include your purchase price, plus incidental and enhancement expenditures. Step 3, deduct any available reliefs, like rollover or gift relief. Now, Step 4, deduct your current year capital losses. Listen to me carefully here. Step 4 is compulsory. You absolutely must use current year losses, even if it ends up wasting your exemption. Step 5, deduct the annual exempt amount. And finally, Step 6, deduct brought forward losses. But remember, for Step 6, this is discretionary. You only use what's needed to bring the gain down to nil. Now, let's talk about this number, £3,000. This number is critical. For the 2024/25 tax year, this is the annual exempt amount, or AEA, for individuals. If you're dealing with trustees of most settlements, that number actually drops to just £1,500. And here's the kicker. The AEA is a strict use it or lose it allowance. You simply cannot carry it forward to future years if you don't use it up. When you're allocating your remaining basic rate band across different types of gains for 2024/25, you're essentially facing a strategic puzzle. Always allocate your BAIDR gains first, because they sit at a flat 10%. But what about the choice between other assets and residential property? Well, you want to allocate the basic rate band to other assets first. Why? Look at the math. Other assets jump from 10% up to 20%. That is a massive 10-point differential. Residential property only jumps from 18% to 24%, which is just a 6-point differential. So as a tax planner, you maximize your tax savings by focusing on that larger 10-point gap. Often, you aren't going to sell the entire asset. When you make a part disposal, you have to apportion the base cost. The formula for this is total cost multiplied by A divided by the sum of A plus B. In this formula, A represents the gross proceeds of the part you actually sold. B represents the market value of the part you've retained. The sheer beauty of this formula is that the retained part keeps that remaining unallocated cost safely stored away for any future disposals. All right, take a deep breath. We've reached Section 3, shares and spousal transfers.
This is precisely where the examiner heavily tests your strategic judgments and your ability to plan effectively. Let's walk through this carefully.
When we look at disposals between spouses or civil partners who are living together, they are treated under the no gain, no loss rule. Let me tell you, this is a remarkably powerful planning tool. It literally allows a couple to double their AEA to £6,000 before making a third-party sale. Or it lets them shift income around to utilize lower tax bands. But I have to sternly warn you about a major catch. The base cost transfers, too. There is absolutely no step up to current market value. The receiving spouse simply inherits the original historical purchase cost. The gain isn't erased at all. It's merely deferred.
Now, what if quoted shares are gifted? And I stress gifted here, not sold. You cannot just use the mid-price. You have to use what's called the quarter-up or half-up method, based on the stock exchange daily official list. You take the lower closing price for the day, and you add exactly 1/4 of the difference between the higher and lower closing prices. It's a specific calculation, so make sure you memorize this formula solely for gifts.
Let's see how we identify which shares are actually sold by using the Section 104 pool. But wait, before you even touch this pool, you must check your rules. Check Rule 1, where any shares acquired on the exact same day. Then check Rule 2, where any repurchased within 30 days. You have to catch those bed and breakfasting traps first. Once you're past those, then you pull the rest. For example, if we combine a January 2018 and a March 2020 purchase, it creates a pool of 1,500 shares with a total cost of £8,500. When 600 of those shares are sold in October, you apportion the cost directly from that pool. So 600 divided by 1,500 multiplied by the £8,500 cost. That gives us a deductible cost of £3,400 for this disposal.
And looking at share strategies brilliantly illustrates a very common exam trap, dividend stripping. This is where a clever shareholder extracts value as a dividend right before selling. This naturally lowers the share price, effectively converting what would be a capital gain into dividend income. Sounds smart, right? But you have to do the math. A basic rate taxpayer pays a mere 8.75% on dividends versus 10% on CGT. So for them, yeah, it works perfectly. But a higher rate taxpayer, they pay a massive 33.75% on dividends versus just 20% on CGT. For them, dividend stripping is a terrible, terrible idea. You must always prove the math before making a recommendation in your exam. Okay, moving into Section 4, Special Scenarios and Losses. Pay close attention here because these are the edge cases that truly separate the competent students from the top-tier candidates.
So, imagine a business is sold, and part of the payment is deferred in an earnout. When you see this, you must immediately identify which scenario you're dealing with. Scenario A is fixed installments. The amount is certain from day one. This creates a single upfront gain on the full amount. Simple enough. But contrast this with Scenario B, contingent consideration. Here, the final amount depends on future performance. This actually triggers two separate disposals. The first disposal is on the cash received today, plus the present value of the right to receive future money, which is known as a chosen action. The second disposal happens later, when that future money actually arrives. And tragically, you cannot claim business asset disposal relief on that second contingent disposal. Let's look at another advanced tactic. You can extend income trading losses against capital gains under Section 261B. Basically, this treats your trading loss as a current year capital loss. But hold on, do you remember step 4 of our computation? Current year losses are compulsory before using the AEA. So claiming 261B might completely wipe out and waste your £3,000 exemption. You must carefully instruct yourselves to calculate the trade-off. Only claim this relief if the actual tax saved on the gains is strictly greater than the tax you lose by wasting the exemption. Rounding out our special rules for today, let's talk about chattels, which are basically tangible, movable property. First off, if you sell them for £6,000 or less, they are entirely exempt. Boom, done. Second, if the proceeds are just over £6,000, you have to apply the marginal relief formula to cap the gain. Third, remember that wasting assets, meaning things with a predictable life under 50 years, require you to steadily write down their allowable base cost over time. And finally, just maintain a brief awareness of principal private residence or PPR relief. It exempts your main home, and remember that the last 9 months of ownership will always qualify for relief, even if you've already moved out. All right, we made it to Section 5, Winning BPT Exam Strategies. We are shifting gears now from pure theory to how you actually secure your marks and conquer that 2025 paper. If you take absolutely nothing else away from this explainer, please remember this one golden rule.
Always set out the full CGT computation in the correct order. Never skip steps. Never change the sequence of deducting current year losses, then the AEA, and then brought forward losses. Presentation marks are heavily on the line here, and simple structural mistakes will cost you dearly. The examiner definitely has some favorite traps, but you're going to avoid them by doing the following. Show your basic rate band calculations explicitly. Don't just lazily apply the higher rate without proving why. When you're dealing with shares, state the rules by name. Write down, I am checking Rule 1, now I am checking Rule 2, now I'm using the pool. For earnouts, state clearly whether it is fixed or contingent before you do any math at all. And finally, always state your assumptions and prove your tax planning logic mathematically before recommending strategies like dividend stripping or Section 261B. You have to show your workings. So we have covered the entire framework, the 6-step mechanics, strategic family transfers, and even those tricky edge cases. You now hold the complete blueprint for Chapter 5. The only question left is this: are you ready to apply these exact rules to your exam paper and pass BPT? I highly encourage you to take these structured notes we just went through, open up your workbook, and start conquering those practice questions immediately. You have absolutely got this. Best of luck with your studies.